Welcome to Candlelight, where price is a mechanical function. In this video, I'm going to be going over how to understand ratios. Ratios are your saving grace, particularly as a beginner. Chances are if you're a beginner, your success rate isn't going to be that high, and that's to be expected. But your ratios are going to keep your account alive. All ratios are is how much are you making on your winners versus how much you're losing on your losers. And per trade, you should be making or targeting to make at least 3 times more than what you're risking. So let's just say that you're shooting a 50% success rate. Half the time you're making 3 times as much. Now, if you're not shooting a 50% success rate, then if you have ratios per trade, you should risk 1% of your portfolio. Let's just say you lose the first trade, so that's 1%. You lose the second trade and you lose the third trade, you're down 3%. But on the fourth trade, you make 3%. So you're back to break even, shooting a 25% success rate. That's going to keep your account alive at the beginning. And once you get better and up your success rate to, let's just say 50%, then half the time you're making at least 3 times as much, which is a very good living. Now this applies to all trading and investing in all markets, futures, crypto, options, stocks, doesn't matter. Now to understand ratios, you need to understand position sizing. All position sizing is how many shares, if you're trading stocks, or how many contracts if you're trading futures, are you gonna buy or short? It depends on the zone. But how much? Let's just keep it simple. Let's just go long. If your zone is big, you're gonna pack on less shares as opposed to a zone that's small. You're gonna have to pack on more shares because you always want to risk 1% of your portfolio per trade. And I'm about to explain that to you in this case, or in today's chart, I'm going to be going over a stock, Alcoa. So let's get into it and let's give you some visuals. All right, so this is a stock chart of Alcoa. My left-hand chart is a daily chart, which means every candle represents 1 day's worth of price action. My center chart is a 240 minutes, so that's 4 hours. And my right-hand chart is a 60-minute chart representing 1 hour. And I'm also going to be going over a 5-minute chart, where every candle represents 5 minutes. But let's just go over the first one. So to go over ratios, all ratios is this is your area of demand. This is where price rallied from ballistically, and the origin of all large moves is where an imbalance of supply and demand is. In this case, it rallied to the upside, so that's where demand is. When price enters demand, price rallies. This is your area of demand. From the first or from the top point, your entry line, which would be right here, that's at $31.45, and a tick below the low is $30.02. So your area or your demand zone is $1.43. So that's a pretty large area. But this would be 1% of your portfolio. You're going to risk 1% of your portfolio here, and I'm about to show you the math. So you're risking 1% to hopefully make it to target 1, which is up here, your first area of supply. And if it continues to if it continues to go higher, fantastic. But let's just say that's your target 1. You're going to risk 1% to hopefully make at least 3, preferably 4 times as much. And that's all ratios are. You risk 1 to make 1, 2, 3, 4 times more. That's a 4-to-1 ratio. That's pretty good. That's a very good trade. This is where position sizing comes in. The $1.43 is a very large zone. That's, a dollar has 100 cents in it. And so that's 143 cents. That's a very large zone. Let's just say you have a $50,000 account. You want to risk 1% of your account per trade, so that's $500 per trade. All you do is position size at this point. So you say $1.43 times 350 shares is going to be is worth $500.50. So let's just say $500. So if your area is large, then you're obviously going to put on fewer shares, as opposed to if you have a small zone, you're going to pack on obviously more because it's a smaller zone. And you want all trades to be equal. This is what's so critical. Even if you're trading a daily demand zone, because it's big, because it's a daily chart, the price action is just going to cover more area, you're going to pack on less and only risk 1% of your trade to hopefully make at least 3 times more. So if you're going to risk $500, you want to make at least $1,500. In this case, let's just say that you cash out already right here, right? Then you're up $2,000. You risk $500 to make $2,000. That's awesome, because sometimes you're going to lose, and then you're going to lose $500, but you're still up $1,500 after that $500 loss. But this is why position sizing is so important. All trades, every single one you make or you take, they're all worth the same. So let's go to a 5-minute chart. Now, let's just say that you didn't get in at the bottom, but I'm gonna direct you to my right-hand chart here. Right here, you're clearly in an uptrend, in a short-term uptrend. Here's a rally base rally. That's a pretty good demand zone. So within this rally base rally, let's go back to the 5. Here are your 2 demand zones. One is here, and your other one is right here. You're expecting price to turn. So for price to come back down into demand, it's obviously going to need to be in some kind of downtrend. It bounces or it falls into your demand zone and then rallies to break your downtrending trend line. Now you're back in an uptrend. Where's the area of demand that broke that trend line? It's down here. This area is only 10 cents. It's from $36.30 to $36.20. That's a 10-cent zone. 10 cents times 5,000 shares is $500. You're always going to risk the same 1% per trade, no matter what time frame it is, as opposed to the 350 shares to make sure we only risk $500, which is 1% of a $50,000 account. On this smaller one, we packed on 5,000 because that makes sure that you are risking $500, and then you want to make, at least 3 or 4 times as much. And here price comes in, and then you cash out at, let's just say 4 to 1. It continues to rally, but let's just keep things simple. You're able to make a 4 to 1 trade on a 5-minute zone, also giving you $2,000. So all trades are the same. All trades are weighted equally, and you do that by making sure that you always risk 1% of your portfolio, never more. And if it does go against you, that's why you have a stop loss, in order to take you out of your position if you're wrong. Love your little losers. And they equal, or they will yield you the same profit. Just because it's a daily zone, which is a bigger zone and obviously more powerful, don't think that it's going to work your way. You don't want to risk 5,000 shares on $1.43, because that you're going to be risking 10-15%, I don't know how much, of your account on one trade. And let's just say that you lose on that larger zone trade, but your 5-minute zone trade, like this one, does make you money. But as opposed to on your daily zone, where you lost so much more, your 5-minute zone trade, which was a 4 to 1 winner, isn't going to pay for your losers. So you want all trades, no matter how big the zones are, to be weighted equally. And that way, your ratios come into effect, where if you have some losers, because every trade is weighted the same and you have a high ratio, your winners will pay for your losers and then leave you some profit, which is exactly what trading and investing is. You're going to have some losers. That's part of that's your overhead. But using ratios, your winners pay for your losers and then leave you some profit in the meantime. Hope this was helpful. I'll see you guys in the next one.